So is the Reserve Bank truly helpless against the inflation menace? Abhik Barua, Chief Economist at HDFC Bank, and Shanta Ghosh, Principal Economist at Deloitte India, join us now. Many thanks, gentlemen, for joining us. Abhik, let me come to you first. I've been reading a whole bunch of research reports, and one that caught my eye says, with this increase, the Reserve Bank has avoided a big bang approach to the rate tightening cycle and has refused to press the alarm bells on inflation. Was a more hawkish action warranted at this point in time? Has the Reserve Bank done enough, as Lata was pointing out, to rein in inflationary expectations with this policy?
My personal opinion is that it has done what needed to be done. I mean, I think it's sort of helpless beyond a point, because the primary source of inflation happens to be food prices, which has its own sort of dynamics and constraints. The issue is that we tend to forget that the RBI has actually done quite a bit. It has effectively hiked the policy rate by about 3 percentage points over last year. So it's not as if it's sort of embarking on a tightening cycle, as many other Asian central banks are doing at this stage. So I would sort of, instead of shock and awe at this stage, I sort of prefer continuity and a consistent approach to monetary management, and that's exactly what the RBI has done. It hasn't ruled out the prospect of more rate hikes. In fact, it's actually almost explicitly committed to hiking rates more going forward. But yeah, so I personally wouldn't favor a shock and awe kind of approach at this stage. And there's a limit to which I think even inflation expectations can be handled through monetary policy, because the primary source of inflation expectations happens to be high prices of food. So unless there is some very decisive action on the supply front to sort of signal to households that food prices have come down, or the government has responded to a shortage, it's unlikely to bring inflation expectations down. So I think there could be the risk or the danger of the RBI overcompensating for some structural gaps which are really outside its ambit and remit, and that the RBI has avoided. But I think it's stuck to a stance of continuous hikes and tightening, which I think is good at this stage.
Shanta, would you agree with that the need of the hour is not really shock and awe, but a continuity in the stance that the Reserve Bank has taken, and taking the inflation point forward, 5.5% now, the Reserve Bank is talking about a 7% inflation rate, and also saying that there are several upside risks already visible due to global and domestic factors. Keeping that scenario in mind, what is the kind of rate hike that you are anticipating going forward?
Right, I think I agree with what Avik was saying, because you have to recognize, as the Reserve Bank also has categorically stated, that a large part of this current inflation is driven by these short-term structural imbalances, which are driven by supply bottlenecks, and really a monetary policy rate hike works through the demand route. So I think what the governor has said is that this rate hike is to stop this inflation becoming generalized, and second, to rein in inflationary expectations, which I think play a very important role in sustaining an inflationary environment that we've seen in the last few weeks. Moreover, Shireen, I would like to also add that there is another concern that the governor has pointed out, which is this high current account deficit. And 3.5% of GDP is a very high current account deficit. And if the RBI had raised interest rates by 50 basis points or 75, which some people have been suggesting, what that does is it increases the interest rate differential between India and the rest of the world. And more money would flow into India, and that would create a pressure on the rupee, which would hurt our exports. And that is not going to be good for the for financing the current account deficit. So I think it's a very fine balance that the governor had to maintain, and I personally think that shock and awe was certainly not the need of the hour at this time. Coming back to your point on the 7% revised inflation.
Yeah, go ahead.
I think going forward, there is going to be some correction in the food price inflation that we have seen, and that's clear in the policy statement as well. And so I think wait and watch is the right thing to do at this stage. And personally, I think that we have to adjust ourselves to a slightly higher inflation, because with higher growth, we cannot have a 5.5% inflation going forward. So if you're going to grow at 10%, I think it's time for us to reconsider what the long-run acceptable level of inflation rate in the country is going to be.
All right, Abhishek, let me pick up on the point that Shanta was talking about, and really the issue there with the twin deficits, the current account deficit and its financing, as well as the fiscal deficit. The Reserve Bank has said that the current account deficit of this magnitude is really not sustainable. So given that scenario, what really is then the outlook on flows and the outlook on the rupee?
Well, I think the rupee will, be under pressure for a while now, because the current account deficit is clearly wide, and from what I understand, there is sort of some degree of bearishness on Indian assets, particularly equities, that's building up, and that's sort of impinging on flows. We've had a problem with FDI for a number of reasons, some related to policy, so on. So the pace of capital inflows has abated quite considerably over the last few months, while the current account deficit continues to be fairly wide. So the net result will be downward pressure on the rupee. There will be some support from debt-related inflows, because the differential between India and developed markets in terms of interest rates is fairly significant, and that should invite flows in, particularly through ECBs. But I think in terms of the currency, it will remain under pressure for a while until there is sort of, again, a turn in global risk appetite and a tendency among portfolio managers to take a fresh look at India. But over the next couple of months, I would tend to be a little bearish about the prospects of the rupee, but certainly not get carried away. I think we're looking at 46.5, 47-ish for the rupee versus the dollar, but nothing beyond that, because while there are risks and pressures, there are supports as well, and I mentioned one of the supports earlier.
So finally, Abhishek, the kind of rate hikes that you're now anticipating, 100 basis points in 2011?
I would think anywhere between 75 and 100 basis points, because I think the RBI needs to keep the pressure on, as Shanto mentioned, and which the RBI articulated very clearly in its policy statements. It's not food inflation that or managing food inflation that's their remit, but it's the second round impact, particularly the wage inflation that's there, the inflation expectations and so on, and that requires, instead of a one-time shock and awe kind of approach, I think it requires a consistent commitment to monetary tightening, and that's what the RBI seems to want to continue. So, given that, I see 3 or 4 more rate hikes. There could be pauses in between, driven by temporary factors, developments, and so on. But overall, I think 3 to 4 more rate hikes is what I am looking at.
Shanta Ghosh, my final question to you on the liquidity front. The Reserve Bank is also committed to ensuring that liquidity doesn't become too tight. On what you heard from the central bank, what's your concern as far as liquidity is concerned?
Well, I think the mismatch between deposits and the credit growth that has been seen and pointed out is a cause for concern. Certainly the last thing we want is banks to be over-leveraged. And so I think, I believe that the credit conditions, the liquidity facilities that we have seen, and the kind of policy measures that the governor has talked about are in the right direction. I think, again, nothing drastic is warranted at this stage, because it's important not to dry up liquidity too fast. So I think, this cautious approach of extending this LAF facility by a few more months, and monitoring the credit growth as well as the deposit growth, and trying to sort of attain the target levels that has been laid down, is probably what we are going to see. And I think I agree with that approach.
All right, gentlemen, we'll have to leave it there. We've run out of time. Shanta, Abhishek, many thanks for joining us on What's Hot this evening.